right.
All right, so we're ready, Daniel? We're on? Okay. I'll go ahead and start here. Well, welcome to the Economist Next Door, an economics podcast for everyone. My name is Paul Mueller. I'm a senior research fellow at the American Institute for Economic Research. And today we're going to be discussing monetary economics. This is the focus of one of our teams here at AIER. And I'm joined by a couple guests. But first, I want to set things up in terms of what monetary economics is about, at least at a high level, why it matters for people. So we all use money every day, whether it's the paychecks that we receive or buying groceries or buying something on Amazon. Money is a huge part of everyone's lives and how we interact in the economy. Of course, if you ever take out a loan for cars or houses or credit cards, the interest rate that you pay is affected by monetary factors and monetary policy. And then, of course, the value of the dollar matters when it comes to trading with other countries or if you travel internationally. And of course, geopolitical influence in terms of the state or the power of a country and how much that it can buy. And then the economy itself, when we think about growth, production, employment, those things are all affected by what's going on in the monetary system, the availability of credit, interest rates, and so forth. And so when we think about monetary economics, we're looking at a lot of different issues. So we'll be talking some about the Federal Reserve System, which is the central bank of the United States. We'll be talking about interest rate targeting, how the Federal Reserve sets interest rates or targets interest rates and how it does that, why it does that. We'll talk a little bit about liquidity, the availability of money and credit to borrow or to lend in the economy, how Federal Reserve policy, monetary policy affects GDP growth, employment opportunities, wages, things like that, and how monetary policy can be expansionary or contractionary, how the Federal Reserve has a large balance sheet that it manages, why it does that, what that looks like. And then, of course, behind all of this, when we talk about monetary economics, the idea of inflation or the idea that the dollar has less purchasing power, it can buy less over time, is a central issue when it comes to understanding money, monetary economics. And so we'll be talking about that. And AIER has a project related to our monetary team called the Sound Money Project that we'll probably talk about a little bit here as well. But with that introduction, let me introduce my guests and give you a chance to hear from them and how they got involved here. And then we're going to dive into just very high level what's been going on in monetary policy, monetary economics in 2025 and in 2026. What sorts of things should people be thinking about or know about when it comes to understanding monetary economics? So I'm joined today by Lydia Newman, who is our Managing Director of Monetary Economics and coordinating and running that team on monetary economics, as well as Pete Earle, who is the Director of our Economics and Economic Freedom team and a Senior Research Fellow, and he also writes on many kinds of financial issues as well. So that's why I invited him to join us as well. So thank you both for being here. To start off, I want to give you each just a few minutes to share about kind of your background, how you got interested in economics, just to tell the audience a little bit about how you got to where you are, your interest in the field, coming to AIER. So take as long or as short as you want, but just to kind of give them a sense of how does one get involved in writing about monetary economics and doing that. So Lydia, why don't we start with you?
Thanks, Paul. Appreciate you having us on your podcast here. Yeah, how does one get into the redheaded stepchild of economics? If economics is the dismal science, monetary policy is the obscure dismal science. So getting involved in monetary policy for me was mostly a product of trying to understand how the world works. And you usually want to do that, especially when you enter the working world in the midst of a financial crisis. So for me, it was very much a product of 2008 and the government actions. I was studying economics at the time, but hadn't concentrated yet. And it was a big question, what has gone on and why has the world imploded, especially the financial world imploded? What is this housing market crash we're experiencing? And are the responses appropriate? And so for me, I went on an intellectual sojourn into trying to understand what the theory was behind what maybe happened. And that led me to a number of financial texts and to some rather old financial texts. So maybe some listeners on this podcast will be familiar, but I came across some of the Austrian economists and their work in the Austrian business cycle theory, the idea that a monetary authority can make money too easy for too long and businesses can expand beyond what they're capable of producing for the long run, and that can lead to some harsh corrections later down the line. This seemed to match up with my lived experience, including having people whose close family members whose employment was affected, how their houses were lost. And so that sort of started this journey of really wanting to understand the role of money, like what was the fundamental problem in that crisis, which led me to it is the fundamental role of money. And so from there, it's sort of been a labor of love ever since, focusing on understanding the theory behind these things, but also with an eye towards the practical and the policy element. My career has taken me into Congress as the managing director of the monetary policy subcommittee that had oversight of the Fed. I've worked in nonprofits trying to share information about how monetary policy works, trying to bring the theory into the real policy world, at least. And then that journey eventually led me to AIER, where now we get to take that journey a step closer to the people, where we're not just speaking about the theory, but hopefully we're doing the good work to help everybody understand better the role of money and how it affects them, how it affects the price of their labor, how it affects their ability to invest, how it affects their ability to save, how it affects their ability to produce things for the future. So that's the mission we're on. And there's much work to do there to help them understand the role of money, policy, and our Federal Reserve beyond just what other parts of our government do. And it's an exciting one to be on, especially at AIER.
Sure. Well, that's great. That's interesting too, in the sense that the 2008 financial crisis was a big reason why I got interested in monetary issues. I wrote a short book on it, after grad school, and in grad school I decided, do I do monetary stuff? Do I do history? And end up kind of doing a bit of both. But that whole idea of like, how does this happen, right? How does the market shut down and people lose their jobs? And like, what did the Fed do and how responsible is it? And those are maybe an entry point for a lot of people into, I really want to understand what's going on with money and credit here.
Crisis breeds interest, right?
That's right. Well, and it really shows how these issues, it's not just like a technical dial that people turn at times, but it can really break things down or cause significant problems. So we may return to that. Pete, how about you in terms of your background, your interest in monetary issues and finance?
In the mid-90s, I got out of the U.S. Army and I went to work on Wall Street. I did that for over 20 years. Throughout the 2008 crisis, that sort of thing, I was a trader in equities, options. I was a head trader, chief operating officer of a hedge fund. But the last position before I began moving away from trading was I ran the Asian markets desk for a large hedge fund in Midtown Manhattan. So in that time period, my actual academic background was in engineering. I was a very quantity kind of guy. And then a few years into my time on Wall Street, I realized I didn't have any business background or anything like that, so I got an MBA in finance. That helped me for a while, but then not long after the 2008 crisis, but more along the lines of 2011, 2012, I started noticing that entire trading desks were disappearing. That what was happening was a lot of trading desks were saying, to make markets and do certain liquidity provisioning things, it's technical talk, but basically to make markets, to be a dealer in securities or bonds or whatever else, they didn't really need a huge desk of traders anymore. What they needed were PhD programmers. So what started happening is all of a sudden you would see a trading desk that has 30 people on it would suddenly have 4 traders and 1 guy with a PhD in computer science coding algorithms. So that indicated to me that I needed to make a shift. So I went and got a master's in applied economics. And I did that specifically because I wanted to get as quantity as possible. I was already doing a lot of programming, but I wanted to do that. And then very happenstantially, through relationships I had, Wall Street people and my own mentors, I met a fellow who was on Wall Street. He had had a hedge fund. His name was Greg Van Kipnis. I knew him for a while. And he said, up at this place called AIR, which is only a few hours north of where you live, you should come to our gold conference in the summer of 2018. So I said, there's no reason why not. And it seemed like he wanted me to be a sort of a fly in the ointment. Well, everybody's going to talk about gold. He wanted me to talk about Bitcoin. I was an early crypto guy. So I came up here and I got a bunch of friendly arguments and I was offered a job. And at that time, I was flirting with both, I was flirting with Amazon, with JP Morgan. And so I went home and I told my wife, I said, they offered me a job. It doesn't, it sounds good. It's interesting. I don't know how the pay is going to be and anything like that. And she said, you could do that and get a PhD, or you could get another, whatever. So, I mean, that's what I did. That's what I wound up doing. I've been here now it's approaching 8 years. I got my PhD in economics at the University of Angers under Guido Holzmann. I bring a lot of my securities industry, my financial markets experience here, but I also cover a lot of other things like economic measurement, that sort of things. I wind up on the periphery of monetary things because while I have studied monetary economics, a lot of times for me, it's what the Fed's doing, how it's affecting Treasury bonds,
Right.
The repo markets,
Mm-hmm.
SOFR, that sort of thing.
Yeah.
So, I mean, we dovetail, all the scholars in there, we dovetail pretty nicely,
Mm-hmm.
covering all the different areas.
Right. Well, and the technical, like the liquidity markets, the repo markets, the technical side of how monetary policy works are important. And then, of course, you mentioned gold earlier, and you came out recently with a little book about the gold standard. And of course, monetary systems used to be based on gold, and,
Sure.
and they're not as much now. Although there's a lot of conversation around crypto and other sorts of things. And so all these things are kind of interrelated. It sounds like you had kind of a front row seat to the crisis that we were sort of observing from the outside that brought us in.
Yeah, I mean, I remember going in what we now call Lehman Monday. I remember going into the office. I used to show up at the trading desk at 6 and turning on my Bloomberg, and all of the T-bills were yielding negative, meaning people were, I mean, to put it in the most simple terms, people were willing to give the government $1 and get 98 cents back or 99 cents back, purely because they were that worried about the state of institutions.
They were so afraid.
Solvency, yeah. So that's I have a handful of pretty visceral memories over that 21 years that I did that.
Yeah.
So, but that's one of them.
Well, it's funny, the thing about the Lehman, ironically, I was in the city just visiting right around that time that week. And my dad works in finance. I was talking to him. He's like, maybe the Lehman building, are people carrying their boxes out of the doors? And I don't think I remember seeing that, but I was in town when it was a big deal.
I mean, we at the hedge funds, we knew things were happening and happening very quickly. And the one thing that I was doing in August, because Bear had failed several months before. So through July and August of 2008, we were making phone calls to regional banks like Raymond James, like Legg Mason, thinking that if the big banks in the city failed, we would need, large, but probably not New York size, but regional banks to move our funds and things like that to. And it did wind up coming to that, but I don't think any of us envisioned that there would be a massive recapitalization of banks such as occurred. I think we thought that a bunch of them would fall and it would be one of the 100-year things, and then we would get on with our lives. But it was all moving very quickly at the time.
Right. Well, and so much has been written about the 2008 financial crisis, and I think maybe we can dwell on this just briefly. But we spent a lot of time talking about it. But
sure,
there was that big question of how systemic is the failure going to be. So we think if you hear the term too big to fail, that was really embodied or really came out of that crisis where government officials were saying these banks are too large to let fail. We get TARP and other kinds of programs.
And on top of that, there's the dynamic whereby they forced banks even that didn't have that didn't have big problems to take money, just because to take the TARP and the TALF money, because they didn't want them to be singled out. Right, they wanted everybody to take money, so they weren't inadvertently, blowing up other banks and making them way more successful.
Yeah, that's right, and it's very interesting. And Lydia, I want to pull you here in a second on this, but that's exactly right. This concern about sort of
theoretic to it,
the moral hazard of, okay, if you have a bailout program and you only bail out 2 banks, everyone's going to be like, what the heck is wrong with those banks? We're going to pull our money. Okay, what we're going to do is we're going to make everybody take the money, but it had the perverse effect of, well, then everyone's like, I guess all the banks are in trouble, right? The CEOs of Wells Fargo and BB&T have written and spoken about this, where they're like, we didn't have problems, we didn't need the money, we paid it back, subsidized
State
it.
Street too was one that was in perfect shape, and they made them
billions
of dollars.
And ironically, it caused the market to freak out, because the market was like, oh, I guess it's much worse. We knew a couple banks were in trouble. We knew Citibank was a mess, and we knew, but we had no idea it was everybody, and so it sort of blew up in their faces. It caused other kinds of problems. Lydia, you want to jump in here on kind of just your thoughts about how this unfolded, or as you were studying the crisis and thinking about it?
Yeah, it was definitely one of those where you were surprised. I think the Bear Stearns bailout in March of that year was the first thing that was sort of like, wait,
what are they
doing? Why are we doing this?
Guided them into the arms of JP Morgan.
Yeah, so it was like creating the marriage, right? The Fed stepping in to create this marriage to secure the loan for and take over with Bear Stearns. And so I like to remind people, when we were looking at that to begin with, it was like shocking, and then there was this expectation, like, is the government stepping in or not stepping in, and a lot of uncertainty. And a lot of folks say, oh, well, the problem was that the Lehman bankruptcy is what broke the system. And I like to remind people that it wasn't the Lehman bankruptcy that broke the system. It was the inconsistent behavior from the government. If they had let the bankruptcies happen from the beginning, then you wouldn't have had the level of uncertainty that then stemmed from them allowing Lehman to fail.
Yeah, that's absolutely right. What you had 3 different things happen. You had Bear Stearns that was, basically guided into the arms, as I said, Morgan. Then there was a whole weekend where it was like, who's going to be married with who? And Lehman was just allowed to fail. And then 3 weeks later, you had AIG Financial Products,
Mm-hmm.
which got a huge, huge loan. And that was a tiny, tiny institution, which was really at the center of the credit default swap part of the crisis.
That's right. And there's speculation about whether it was kind of almost a backdoor bailout to their counterparties. The people that AIG owed money to are the ones that are being made whole through the insurance that they
And that's
sold.
interesting because the same arguments are made about things early in the Great Depression, where the government bailed out a bunch of railroads who owed money to JP Morgan.
Yeah, so that's one of the things that we do here at AIR is sort of thinking through, like, what are the second order consequences, or who's actually benefiting behind the curtain here. Well, let's zoom out a little bit and then think about sort of the monetary implications here. And maybe very briefly, Lydia, I'll let you kind of tee off kind of how some large picture monetary issues, especially with the Federal Reserve and interest rates and credit, kind of teed up the crisis a little bit. And then let's kind of transition to talk about what's happened in the 15, 18 years since to kind of bring us up to where we are now in terms of financial markets, but then also monetary policy. So let's try to connect those things and then talk about kind of where we are today.
Yeah, so the Fed's response in that crisis, in fact, actually informed their crisis response in COVID. And I like to argue actually maybe caused them to create the 9% inflation we experienced in 2022. To go back to where the origins of that started, the Fed was adamant not just about these bailouts and creating all of their liquidity facilities, meaning the Fed creating money, like we should be reminded that what the Fed can do is add zeros and ones to their computers.
That's right.
To create more dollar-denominated assets on their books, dollars on their books. Then they usually deploy, or back then would deploy and go and buy assets to engage in whatever monetary policy or monetary measures they wanted to. In that case, they weren't just engaging in monetary policy, they were trying to do financial crisis management and created a bunch of lending facilities, expanded their balance sheet, meaning they created 4 times the amount of ones and zeros they had typically had, and bought a bunch of assets, including questionable assets like some mortgage-backed securities that seemed at that time with the subprime crisis seemed to be a questionable purchase. And so they increased the amount of money in circulation at that time through those programs, but also dropped interest rates to essentially zero. I'll put a little pin in this point. The Fed also got a new authority at that time in 2008 to pay interest on the amount of money that banks would keep at the Federal Reserve. This is called interest on reserves.
Yeah, and let me pause you there for just a second, just for people who aren't as familiar with the Federal Reserve. This is a slight simplification, but in many ways, you can think about the Federal Reserve, a bank's bank, right? We put money at the bank, and I have a checking account or a credit account. We pull money out, we put money in. Well, banks do that with the Federal Reserve. And so what you're referring to in terms of the ones and zeros the Fed creates, the Federal Reserve can actually just add money to banks' accounts at the Fed, and they can do that in exchange for bonds or treasuries or other kinds of assets. And they did a ton of this in 2008 to provide the liquidity.
And I mean, everything that Lydia said is correct. And of course, 2 things. First is some people believe, as I've read, some people believe that the reason we didn't get inflation, or at least any material inflation after 2008, is because those reserves were kept safe at the Fed,
on the
earning
accounts.
Interest. So I mean that kept them from lending a
Right.
lot. Whereas in 2020, there was an active effort to liquefy the economy, to send out stimulus checks and put out money on that. The other thing is that many of the programs that were developed in 2008, the commercial paper liquidity facility, all these other things, returned in 2020. Sometimes they had different names, but a lot of them, I mean, it seems like they tested some theories back then, and they found that some of them worked later.
Yeah. They're running the same playbook. They basically hear the plays, pull out the playbook. What do we do in a crisis?
But keep in mind, when they ran the same playbook, they learned, or they thought they learned the lesson of, oh, well, we didn't experience higher inflation, and we were stuck in this malaise of an economy for a decade.
That's right.
And so the lesson they took away from that was not maybe we shouldn't have bailed out people and created business uncertainty, and we didn't let assets, get reallocated in the economy. Instead, the Fed just took the bad ones, some of the bad ones on their books. Instead, what they learned is, we just didn't put enough money in the economy.
Yeah, it was the job. I believe it was called like the jobless recovery, because we had this emaciated growth for about 3 or 4 years.
That's right. Yeah. Employment remained high. Unemployment remained high. Yeah, and you're right. And inflation was very, very low. In fact, they were worried about inflation being too low, which is kind of ironic in the recent history.
It is. It's part of that. I mean, we could do it all. Fed's like irrational fear of deflation in any
That's right.
form.
No, you're absolutely, like, I joke sometimes, like, if you want to scare a room of central bankers, go in and shout deflation, right? And they'll freak out because
Prices are down 1/4% of 1%.
Right, exactly. Because like the next Great Depression is upon us.
They'll start handing out $100 bills.
Exactly. Turn on the presses. Yeah, well, so let's talk a little bit, Lydia, going back to you in terms of maybe the Fed's balance sheet a little bit to kind of give listeners a sense of what is the Fed's balance sheet, just in very simple terms, and then how it's grown and grown and grown, from pre-crisis to post-crisis. But then even between 2008 and 2020, before the next explosion, it was growing throughout that period where Chairman Bernanke and the Fed was engaging what we call quantitative easing, where they're expanding it. So maybe just to say a little bit about what is the Fed's balance sheet and how does it grow, and what have we seen happen over the last 15 years?
As you mentioned, the Fed's balance sheet, it's how they add, it's one way of many that the Fed uses to create ones and zeros, more dollars in the economy, to purchase assets like bonds from other banks, and actually in particular, usually a certain set of banks. But during the crisis, they expanded that to a lot of other banks across the system, and even some corporations based on the corporate finance.
You think dealers, like you could?
Yeah, I feel like GE and a couple other large firms. I mean, that's one of the things. It's not only introduce new programs, but take existing programs and expand their availability. Like, okay, now they used to buy just, say, for example, treasury bonds. They're like, oh no, we'll buy corporate bonds too, which is a very big step.
And mortgage-backed securities.
Right.
Yeah,
but
exactly.
They were fairly limited in the '08 crisis to a smaller set of assets than we experienced them buying in COVID. But typically the Fed has only had, at that point, only kept about just under $1 trillion in assets on their books, on their balance sheet, but that multiplied by 4 during the crisis. So it was 4 times as large. I think it hit a peak of like 4.2 trillion. And so that's newly created money just shoved right out into the economy.
Then this is this is going up to COVID. This is not including COVID response.
This is 2008.
This is just growth.
This is the ramp up in 2008. So we thought a 4-fold increase was huge. And then the Fed actually basically has maintained it and not really gone below that 4 trillion since the 2008 crisis. And this has caused them to actually completely shift the way in which they conduct monetary policy. And maybe we'll talk about, I won't go into that yet, but the floor, we call it in economics speak, the floor system, although a lot of people think it does look more like a corridor, but the theory is it being a floor system. But basically, since the 2008 crisis, the Fed has been in a position where it has almost completely moved away from setting interest rates, which is another one of the Fed's policy tools. It has moved away from setting that in a sort of quasi-market oriented setting, and has now essentially moved to a place where they're able to just pick whatever interest rate they want because of this interest rate they pay to banks. The interest rate, it used to be the IOER, the interest on excess reserves, but now they just call it interest on reserves. But I'm going to get back to the balance sheet because they're connected. The Fed has to have a larger balance sheet in order to ensure that it can have a larger amount of reserves in the system. That's more money circulating in the system that the banks will then hold at the Fed, that then allows the Fed to set that interest rate and tweak how much, so they can fine tune how much money goes in and out of the banking system and thus in and out of the economy.
Yeah, I was going to say, the way I like to put it is they've insulated themselves from a lot of market forces in terms of setting that interest rate.
And despite that, it's important to remember that the Fed only controls the first 6 months to 1 year, the yield curve.
Right, that's right.
Even so, the rest of the tail is all market forces.
No, and this is important because people, President Trump and others have said the Fed needs to lower interest rates. Lower interest rates, why? Because of mortgages and other sorts of things.
Sure.
And so what you said is very important. So the yield curve, this idea that the interest rate you get on short-term debt is going to be different than long-term debt. And they're related, but they're not as closely connected as a lot of people think.
So when people usually say to me when I'm on media, they say, well, the Fed lowered rates. Will that lower my mortgage rates?
That's right. Everybody wants to know that.
A couple basis points, maybe. It's not going to go from 8 to 6%. That's for sure.
That's right.
So I mean, it's a parallel move, but it's much less for a lot of reasons. Not just the illiquidity of bonds way out, at the longer maturities, but also, you're dealing with risk over longer periods of time. Right? So all of that.
Yeah. Well, and Pete, I want to follow up on, you talk about part of how you follow the Federal Reserve is its effect on financial markets. So you could speak to the point Lydia was making in terms of how you viewed the Fed moving interest rates pre-2008, the open market operations and bond trading, just maybe a little bit what that was like, and then how that really shifted post-2008 into the world we're in now.
Yeah, starting in the mid 1990s and all the way until really 2008, and maybe even later than that, it seemed like so much of the activity in the financial markets took place in the 24 hours around the FOMC meetings and
Right.
the rate decisions. That's changed a bit now, of course. What Lydia said about the balance sheet taking center stage is absolutely correct, where the Fed adjusts how much it buys or whether it lets bonds roll off or it basically rolls them over. It's going to affect affects the liquidity in the system. The other thing is, and this gets very sophisticated, I won't get too far into this, is repos.
Yeah.
And the repo market's out there, of course, and the big change between the 90s and 2008 is that what happened in 2008, among many other things, is that you had a repo system where it was what was called repo reverse repo.
Yep.
Where basically you'd go into an electronic system and you'd say, I have bonds, I want to pledge, and there are other firms that say, I have cash. Right? We could do a whole episode on repos. But basically, the idea was that I get liquidity overnight. They get the use of securities. They get the incremental, yield for a day or two, and then we switch back. But what happened was one side of that market completely emptied out because during the 2008 crisis, nobody wanted to loan and not know what they would get back. So the new institution is called tripartite, and tripartite means that there's an institution in the middle. There's a private one that's run by a bank in New York. The Fed also does it, where they basically say, all right, I'm going to be in the middle. You give me your bonds, you give me your cash. I'll make sure that you're both solvent, and I'll be in the middle, basically like a referee.
Yeah.
And that's made things a little bit more liquid and a little bit safer.
Yeah.
We'll still find ways to generate crisis. that one is taken care of.
That's right. Well, it's kind of it's this idea of it's almost like this extension of the lender of last resort that the central bank had. You're right. A lot of people don't realize Bear got in trouble, and Lehman as well, because the repos you're talking about, reverse purchase agreements, are basically a collateralized method of borrowing very short term. And so you borrow for like 2 months or 3 months or a day.
Or overnight.
Yeah, or overnight. But the problem is if the value of your collateral changes and people don't like your collateral, you're taking haircuts, which is totally what was happening with mortgage-backed securities, or they just don't trust you as a counterparty, you find yourself on the hook for potentially billions of dollars that you were just going to roll over. And now all of a sudden you have to come up with it and you have to sell assets. And this is very connected to what triggered the crisis and the asset depreciation, fire sales that we talk about. So moving to where we are today, let me comment on the balance sheet, and then we can maybe zoom out a little bit to think through sort of we're very Fed focused right now, which is fine because it's kind of the central institution in a lot of the financial markets. But as Lydia mentioned, so you have this explosion in the balance sheet to around 4 trillion, a little over 4 trillion. It's back down a little bit,
but
it
peaked at 9.7.
Yes, pre 2008 it was below $1 trillion.
Right.
And then post 2008, it had grown a lot, and then they continued to add to it in 2010, 2011, 2012 because of high unemployment, inflation numbers were low, various reasons why they engaged in bond buying, where they just created money to buy bonds and balance sheet grew. You're at about 4 trillion or a little bit more going into COVID. And then through the first few months or the first 6 months maybe of 2020, you see emergency lending and funding from the Fed to try to keep markets afloat. And it jumps to, I think, around 7 trillion. So they add about 3 trillion to it. But what's interesting is even after the crisis had passed, if you go into 2021, the Fed is still increasing their balance sheet. And so it peaks at a little over $9 trillion by late 2021, early 2022. And this is, of course, when we get the quote unquote transitory inflation. And then the Fed begins to reverse course, and they engage in letting some of the bonds roll off over time. We call quantitative tightening, where they're tightening their balance sheet. That actually ended in December of last year, where they basically said, okay, we're not letting any more roll off. In fact, we're going to add a little bit more to it. And it went back like almost exactly. The Fed's balance sheet in December was about where it was after the COVID crisis, but before all the liquidity in 2021. So it's back at about 7 trillion. So they've rolled off about the 2 trillion they added in late 2020 and 2021. They're lowering interest rates again. But let's zoom out here again. So I want both your thoughts and reflections on, okay, thinking about where we are, think about like 2025, all right, in terms of what would you say are maybe some of the high level important things that happened when it came to monetary policy? Like what was significant about 2025 in terms of either a change in policy or target, or, as you think through, okay, 2025 last year, what are some of the big monetary policy, Federal Reserve issues? You can pick one or two that stand out to you.
You want me to start?
Sure.
I'll probably steal your. To me, it was the tearing away of the veil that the Fed isn't or can't be politically influenced.
Okay.
You know, it's Donald Trump basically saying out loud, "I don't like what the Fed is doing.
Exactly.
The president should have a role in setting rates." I mean, if you look back, I think Pete Betke has an article. You can read any number of historical articles about pressure put on the Fed going back. Just about every FOMC chairman has had pressure put on them, except the only president I've ever found who didn't put pressure on the Fed was Obama, because there's nothing they could do. They were at zero all through his whole term, both of his terms. So
I'll push back on that, but go on.
Possible, but I mean, I think for me, that became, we knew about it here, but I think a lot of Americans suddenly realized that, or had the spectacle of seeing the Fed getting real pressure from political forces to influence rates in a way that's outside of what they, what their economic assessment.
And a lot of non-economists started talking about the Fed. I mean, I started talking to like ordinary people, friends of mine who do not follow monetary policy. Like, oh yeah, why isn't the Fed lowering interest rates? I'm like, do you know what? Yeah, exactly. Do you know what that means for the Fed to lower interest rates? But yeah, and this is going to be a big theme we'll talk about, I think, too, about like this year, 2026, and going forward from something we care a lot about, Fed independence and accountability. So we'll definitely return to that. I think that's very important. But go ahead, Lydia, what are your thoughts?
I think this is a fair point that, yes, the 2025 did see sort of this outsized public pressure coming from the President of the United States on the Fed to engage in a specific policy action. But I like to remind people that, yes, we've had public episodes or private episodes that then became public in the past. Think of Richard Nixon putting pressure on his chair during the inflation that led to some of the inflation of the late 70s. But one of the episodes I appreciate some of our scholars in the Sound Money Project have chronicled is how that same pressure actually has existed. It's just been a lot less public. For example, the inflation we did experience in 2021 into 2022, the Fed was slow. Most economists agree the Fed was slow to reining in inflation post-COVID. And it's interesting that the timing really matches up with Fed Chair Powell wanting to get reappointed by then President Biden. And so even though that wasn't made as public, because Powell was willing to do the thing that the president or the president's party wanted him to do, I don't think we should ignore the fact that political pressure was still there.
Yeah.
It just wasn't a conflict in pressure. And so I think we should be mindful that even though this was very apparent, and brought a lot of attention, it isn't new. And so I put that little caveat, but Pete, I completely agree with Pete that was sort of a new 2025 thing, that level of public opposition.
I had a theory, and I actually asked one of our Sound Money people about it, and they said, none of these things are monocausal. There's other reasons.
Yep.
I certainly thought that the Fed was right to be cautious to an extent because there's the monetary factors, there are supply chain issues, there are a lot of reasons why prices might be rising.
Sure.
But I also wondered at the time, are they going to let inflation get to 4 or 5%, whatever, before they act to melt off some of that short-term Treasury debt, which we built up so much of? I wonder if they had, kind of a heads we win, tails they lose kind of mentality.
Yeah.
Because at that time, we had also taken on trillions of dollars with huge deficits.
Well, and that inflation you're talking about, again, it's this measure the value of the dollar. And so the idea is, as inflation rises, fixed debt or past debt becomes less burdensome in real terms. So you have more dollars in the future to pay back the past debt.
Inflation benefits debtors and it harms creditors.
Because it erodes the value or the principal of the loan and the value of the debt.
That's why the late 19th century was full of agitation for inflation, because farmers had gazillions of dollars worth of bad debt.
And before you had pressuring the Fed, you had pushes to mint silver instead of silver and gold. I mean, so it's one of the things about monetary issues, they've been around a long time. Like the forms have changed, but the principles have been there a long time. Devaluation, governments.
Agitation was all about inflation.
Exactly. Governments wanting to have more money or be able to spend more without having to raise taxes, what we call seigniorage, and making money off the currency. So these issues have been there for a long time. Well, so to take the points you both raised and now kind of update it as we think about 2026, maybe 2027, the issue of the kind of very public feuding and pressure that we see. Is that a problem? Is that a good thing? You have a lot of people in the administration say it's a good thing, right? Like Trump should be telling them what to do. And Powell screwed up, and the president and the people should have a voice in monetary policy. So maybe you could talk a little bit about Is that right? How do you think about accountability? What are the dangers of having a great deal of political pressure when it comes to the monetary authority and how money is created and interest rates are set?
I think you're speaking to what a lot of folks will call Fed independence and the value of, or lack of value of, an independent Fed. And should the Fed be able to make decisions without political pressure? The way that our system, well, two things. In the economics literature, you want your monetary authority to be independent, particularly of political pressure. The idea being that you aren't going to politicians very frequently like to ease money conditions, create more money to buy goodies, to get votes and to get reelected. And so you typically want to keep some level of separation between a monetary authority and a politician, so they can't go do that and treat money as its own piggy bank. And so that type of independence is good. But the other type of independence, when you're in a representative democracy like we have in the representative republic like we have in the US, there's that question then of accountability. You can have independence, but how do you make sure it's still accountable to the elected officials without elected officials being able to sway the direction of monetary policy for short-term gains? And this is where I think it gets a little bit tricky and complicated, because constitutionally, it's actually Congress that is supposed to set monetary issues. Article 1, Section 8 is, Congress shall shall coin money and regulate the value thereof. And so they have delegated that responsibility to the Fed. And so when we say, oh, well, shouldn't they be accountable to the executive to say, should you or should you not loosen money or tighten money? The real thing is actually that's constitutionally, at least, that might rest with Congress. Now, that gets very complicated if you want Congress setting monetary policy.
It's hard to get Congress to do anything
that's a whole other host of issues.
I think they would leap at that opportunity.
I think they would.
I don't think they would abdicate that one.
Well, Pete, do you want to add to that too? Especially you alluded to earlier the idea of kind of mission creep at the Fed and like how it's kind of growing. So maybe you could kind of bring that dimension as well.
I mean, the one thing there's a lot we didn't mention about 2008, but the one thing was it's been argued that the Fed picked up a new mandate at that time, financial stability, essentially, right? So there's that. But I mean, about this in particular, what I would say is that I think that, the Band-Aid is torn off, and now the Fed will hereafter, every step of incrementalism, takes place, and then that's the new boundary beyond which others can pass. And I think, maybe they'll do it in a more subtle way, but I think future administrations are likely to do very similar to what Trump has now sort of paved the way for, maybe in a more subtle way. So I think that we're going to continue to go down this road where there will be, pressure put on the Fed, the comments, that sort of thing. Probably a little classier, but nevertheless pressure. If that accelerates the move towards some sort of reform, whether it's a single mandate or something else, maybe it will have been worth it. We'll have to see. But all the incentives are asymmetric. It's always going to be the lower. I can't think of a realistic time when a congressperson or a president is going to say, I think we need to raise rates. Right?
That's right. I can't remember the last time someone really said that. I mean, I guess Reagan let Volcker do it, but
he actually had some words to say about it, but they didn't put near the kind of pressure that has recently. And on the other hand, I often tell people, I say, when my daughters were younger, one time they wanted to watch a movie called Beverly Hills Chihuahua 3. And I was like, we need to raise rates, because if Hollywood's coming up with this stuff, money is way too loose.
It's too easy to borrow money and do crazy projects like that.
Right.
As we wrap here, I'm curious, for you and maybe kind of for our listeners, what's one or two things you're kind of looking or keeping an eye on this year in terms of what do you think will be interesting in terms of developments or to see how things play out? What's kind of on your mind when it comes to 2026? Second year of Trump's term, all these different issues we've talked about with the Fed, large balance sheet, shifting its gears here, pressure to lower rates. What are some trends you're interested in terms of reserve currency or Fed independence or things you're looking to follow this year or that might be important for people to keep an eye on?
There are two main ones, but many more. But the two I'll highlight right now are, of course, the selection of a new Fed chair. Powell's term is up in May of 26.
It's like regime change.
So we expect sort of any time in the first part of 2026 to announce. And so it will be interesting which of I think there are three front runners right now. And so it'll be interesting to see who's chosen and what that then means for monetary policy. And that's going to dovetail into some Fed independence things, questions. And related to that, actually, so I'm sneaking in a third one here, but related to that is the Supreme Court is going to be making a decision on the push to try to remove a Fed official essentially at the discretion of the president. And we're not sure is that in law or not. And so the Supreme Court will make a decision on that. The other thing, a little more wonky to pay attention to, but I think is a sleeper issue that with great significance, is the Fed has recently been releasing a number of speeches and content more in the targeting economists, but about changing which interest rate the Fed is targeting. Because that interest rate, called the federal funds rate, the one that everybody hears about the Fed targeting, it doesn't work the way it used to after all these changes we talked about. But I think this is a sleeper issue that might have significant knock-on effects for the future of monetary policy. I think we're going to, the undercurrent that most people might ignore is that the Fed is moving itself to a different interest rate target. And I think we should just be really, really drilled in on how they might try to choose and do that. And they would do that without any sort of congressional involvement. And there are questions as to whether or not that type of big change should maybe be approved through Congress, maybe.
Well, very good. How about you? What are you kind of keeping an eye on?
Certainly going to be watching those things. But I mean, I am looking to see, I'm looking at the race between Fed accommodation and unemployment, see where that materializes. Did they act quickly enough? Did they not act quickly enough? That sort of thing. So I'll be watching for that to develop in the macroeconomic space. I also, one of my areas is de-dollarization. The role of the dollar. That ties also to something else I've been following since last year, which is the Mar-a-Lago Accord. So, I mean, those developments, as well as, will this action in Venezuela, will some of the things we've been doing, Nigeria, Iran, will that accelerate a move away from the dollar? It's going to be slow, but it is a real shift. So those are things I'll be tracking as well.
Yeah, no, this is great. And I'll just kind of to summarize that these are great things to look for. And as we talked about with the 2008 financial crisis, money seems mundane until it isn't, right? Until something breaks, something changes, the dollar, inflates, or, we saw that inflation period. So even though some of this sounds kind of in the weeds, it can really, these issues can have really significant consequences. So we're keeping an eye on it, and it's worth people kind of trying to learn a little bit more about. But thank you both for joining me. This was great, and I look forward to continuing our conversation together in the future.
Thank you.
Thank you.
All right. See, told you.